Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and in today's episode, we are going to be going over 5 undervalued growth stocks to buy in what is considered to be an overvalued market. If we go ahead and go to the research tab here and we search SPY, the ticker symbol for the S&P 500 Spider ETF, you can see that it is just rocketed higher at all-time highs, breaking new records seemingly every single day, every single week, nonstop. But we're going to go over 5 stocks which in my opinion are not only off of their highs, but have great business models and great stock prices and offer a lot of opportunity for investors moving forward. But before we jump into all of that, if you haven't watched me before, my name is Jordan. I'm a Millennial Investor. Column A right here that I'm highlighting highlights the 22 companies that I currently own. They're all dividend paying companies because I currently have a dividend growth strategy. That is how I make money. That's how I invest in the stock market. But in this video, we're going to be going over 5 growth plays, non-dividend paying companies. And I also track my annual dividend income, monthly YouTube income, and portfolio value updated on these charts, as well as my 5 investing goals for 2021 and my 2021 stock market prediction. If you want to get $30, not 10, not 20, but $30 for getting signed up with M1 Finance, that is down below in the description. Also other things as well, like if you want to reach out to me personally, there are mentoring calls available with my email listed down below, as well as other things like Yada savings accounts, credit card referrals, all that stuff. So if you want to get signed up with anything down below, including M1 Finance, you can check that out down below in the description. But without wasting any more time, let's go ahead and start with stock number 1. The first stock that we're going to be looking at is ticker symbol CHWY, and the stock we're talking about is CHWY. CHWY is one that I absolutely love as a business. I love as a stock. This company has a track record of having one of the highest customer satisfaction ratings you'll ever see of pretty much any company out there. Basically, the way I look at them is that they're the Amazon version of taking care of pets. They have a great foundation, great leadership, and this company, for the first time basically since going public back in, let's see, the summer of 2019, so yeah, we're almost down to the day, 2 years of this company being public. They initially went public around the $35 a share range, and today they trade at $75. But if we look at the year chart here, honing down a little bit closer, you see at the all-time high for this company traded around $120 a share. But today it trades at 75, so a steep discount from where its all-time high was. Now furthermore, not only is the stock price going down, but this company is still growing at record numbers. This company continues to innovate, continues to grow, and it's not just a boring pet company that sells pet products. They are also expanding into new services, with one of their main focuses being Connect with a Vet. If you've ever heard of the company Teladoc is a company that provides health services to humans over the phone, through the internet, through Zoom calls, things like that. Well, CHWY is wanting to do the exact same thing, but for your pet's health. If you've ever wondered about if you should take your dog or your cat or whatever pet you have to the vet, CHWY now has a service that directly offers those telehealth services directly for your pet, where you can ask questions to real veterinarians, offer pharmacy subscriptions to your pet's health needs, and this really gives CHWY another opportunity to interpret more data from its customers. And one of the best things I love about this company, if you've heard anything about adoption rates, pet adoption rates for 2020, when the pandemic struck, when chaos happened, people were adopting pets like crazy. People were bored, people were sad, people were lonely, they were stuck indoors, and so pet adoption rates across the boards, obviously specifically for cats and dogs, the most popular, but pets and dogs across the board, adoption rates skyrocketed. And so if someone adopted a puppy or a kitten last year, that cat or dog is now 6 months old, a year and a half old, that dog or cat is just going to grow up. It's going to eat more food. It's still going to need more chew toys. It's still going to need lots of other services, including like those vet services like we talked about. And I think this is an opportunity to potentially be a CHWY investor. And this gives an opportunity to buy this company at a discount that was just a few months ago, back in February of this year, trading at 120 plus. Today it trades at 75. So that's an opportunity there. Next up, we have stock number 2, and this is one that a lot of retail traders have been excited about, and that is Tattooed Chef. And speaking of new companies on the market, this is a company that, while most SPACs are really risky, this is a SPAC that just went public about a year ago, once again almost down to the day, a year ago, kind of a weird coincidence. But this company originally went public at around $10 a share and hit all-time highs of almost 30. I think at one point it reached $28, $29 a share. And since then, it is now down about 20% plus off its high, and that's even with the stock price recovery. Because just a few weeks ago, about a month or so ago, this stock was trading trading at $15, $16, $17 a share. Now, this company is not your traditional old risky SPAC with no business model. This is a company that has massive growth ahead of it, as well as massive profitability opportunity moving into 2022, 2023, and beyond. And if you want to look at the history of Tattooed Chef, you can go ahead and pause the video right here, and it talks a little bit about how Tattooed Chef came about. Growing at a 5-year compounded annual growth rate, a 5-year CAGR of 63%. And this company is currently expanding into new deals with any big name you could possibly imagine. Either potential deals or past deals that have been announced within the last year or two. This company has gotten deals with Costco, Walmart, Sam's Club, Target, Whole Foods. This company continues to get so many incredible deals. While this company may be in the early stages of the growth story, it really reminds me a lot of like the little brother to a company that I've always been a fan of, which I still think is always a great investment, is Beyond Meat. I think that Beyond Meat, they've started to really put their foot in the door with international expansion, and they've really got a lot of the big brand name deals that everybody knows and love, including names like McDonald's and Del Taco and Taco Bell and Pizza Hut and all these big names out there that are really important for a company like Beyond Meat to be successful. Now, the way I look at Tattooed Chef is kind of like the little brother that's in the earlier stages of that. They're just starting to get these really big deals, like I said, like a Sam's Club, like a Walmart, like a Target, whatever. But this company has not really had that international expansion yet. They just started testing in the UK, and they also have a little bitty tiny expansion into Canada. But this company just acquired another business as well for $35 million, and they're looking at expanding even much faster than they initially anticipated. So Tattooed Chef is a really high grower. It's an exciting company, and as far as food companies go, it's arguably the most exciting company you could invest in. Not going to say it's the best investment or going to be the most profitable, but as far as excitement, this is one that I could see really being a big winner. This is the type of stock that is either probably going to zero or is likely going to be much, much, much bigger from these levels, because only trading at a $1.8 billion market cap. If they could ever even get half the size of, say, something like a Tyson's Food. Tyson Food is one that's in the freezer section that sells a lot of the same products. This company is literally 20 times the size of Tattooed Chef. And so if this company could even get half of the size of Tyson Foods, Tattooed Chef could get many multiples above this level, well easily to a $100 stock price many years into the future if they were to ever to get to that size and that scale. And their main competitor, like I said, the big brother of Tattooed Chef is Beyond Meat. That's a company that has been a little bit more developed, had a couple more years of experience behind it, and that currently trades at a $9.2 billion market cap. And so while Tattooed Chef doesn't have quite the revenues and profits right now, it is expected to have those next year, 2023, 2024, and beyond. So Tattooed Chef, a really fun, interesting one to own going into the future in the food space. Now, next up, we have one that has really grown a lot. And this is one that a lot of you probably know and probably even use their services. If you like music, if you like podcasts, if you like streaming, this is a company that you probably know and love. Spotify is one that has came down a lot from its previous highs of around $365, $370 a share. Today, it currently trades at $236, so a big downturn from its previous all-time highs. And I think if you're wanting to be a Spotify investor, now is likely one of the better times to enter into a position. You are now buying it at a significant discount from its previous all-time high, and the history and the track record of revenue growth for Spotify is pretty incredible. From $2.9 billion in 2016 to $4 billion in 2017 to $5.2 billion in 2018 to $6.7 in 2019, and then of course with the pandemic, everybody being stuck inside, still growing to $7.88 billion. This company has a track record of growing revenues incredibly fast. It's a founder-led company with a fantastic CEO, and while this company has had some trouble with profitability in the past, that is not really an issue because they've only been focused on revenue growth. They've only been focused on growing that market share, beating out competitors like Apple in the music space, but I think that this company will have a big profitability story moving forward. Now, Spotify has made a lot of huge buys, like for example, buying out one of my all-time favorite, the Joe Rogan podcast, spending millions and millions of dollars to acquire people like him on their platform. I think that is just opening the door to all the different types of opportunities what Spotify has moving forward, not just with podcasts and not just with music, but really making them dominate in the space. And me, myself, I have been a Spotify user since I've been in high school, since I was probably 15 years old, and I'm 22 years old right now. So many, many years. I love the service. I love them as a consumer. I would like them as an investor. It doesn't fit with my dividend growth investing strategy, but I do love Spotify, and I think it is going to be a good story moving forward. Now, next up, we have one that I did make a video about because I don't make a lot of videos about growth stocks, but I did make one about Corsair Gaming because as far as a valuation standpoint and the risk reward goes, I think as far as the risk reward opportunity goes, this is by far and away the best out of the 5 companies that I can recommend. It's a smaller company at just under 3 billion, 2.9 billion to be exact, and it currently trades at $32 a share. Now it went IPO price at about $17 a share, and it's a little under double that stock price, but it is finally trading at a discount the back half of 2020 in the early half of 2021. This company broke $50 a share in late 2020. In November of 2020, it was like 52 or 53 was the peak, and now this company trades at $31.86, a significant discount from its previous all-time highs. And basically, the way I look at Corsair Gaming, not only are they a great company, but they are a company that is in a fantastic space. It is streaming, it is gaming, it is esports, all that type of stuff is what Corsair Gaming sells their products in. Now, if you look at their market share, if you look at their position for where they sell their products, as far as their market share goes, they're usually either number 1 or number 2 leaders in the space for nearly every single product they sell. They sell things like mouses, keyboards, SCUF gaming controllers. They sell things like lighting equipment, streaming equipment, Elgato game captures, all the things that go along with gaming and streaming that you could possibly imagine. Now, of the products that they sell, they have some competitors like Logitech, for example, that sometimes beat them out in the space, but generally speaking, like I said, across the board, they're usually either number 1 or number 2 in the space, especially with their gaming PC sector. But Corsair Gaming is a stock that trades at a very low level with a forward PE ratio of only about 16, 17, and this is a company that has raised guidance, raised profitability, raised revenue estimates over the past 6 months, and the stock, let's look at the last 6 months. It's went nowhere. It's trading in a range of about $40 a share to $30 a share, and especially in the last 3 months or so, it's really went nowhere. Up a couple percent, down a couple percent, and I think Wall Street is really starting to question whether or not this is going to be a one-time boost from the 2020 gaming boost that we saw from the pandemic, and if that's going to be moving into the future. I think, and statistics agree with me, that the gaming industry is poised for growth in 2020, it's poised for growth in 2021, 2022, and likely pretty much all of this decade. And so Corsair Gaming, even if this company didn't innovate at all, which is very unlikely, but even if this company didn't innovate at all, didn't come out with new products, the industry itself is poised for fantastic growth. So as this company, as it has a history of lots of mergers and acquisitions, as it continues to buy out smaller gaming companies, I will see more of that in the future, likely if I were to guess. And so as this company comes out with new products, it has extremely profitable margins for its hardware, has opportunities with software as well, potentially buying out those other smaller companies, and trades at an incredibly low discount with a growing industry, I think that Corsair Gaming is one that has massive opportunity in 2021 and moving forward. And then last but not least, we have Splunk. Splunk is number 5 on the list, and what's really interesting is to see this company transition from an old school company to a new school company. It had an all-time high in stock price just the other day in 2020 at about $220, $225 a share or so. And today it trades at half that price, technically under half that price. It trades at $112 a share. This company, if we look at the year chart, it has been pretty much straight down over the last year, and this is a time when the market has really started to take off, and this company has lagged all the way. Now, this company does have a history of growing revenues quite nicely, but it has had some issues with profitability, and it is finally getting to a level where in 2022, it is finally looking at making a profit. The good news is, it's with all the big names that you could possibly imagine, including Amazon Web Services, Azure, Google Cloud, all that stuff. And just to give some examples of some other names, like down here below, Intel, Comcast, Coca-Cola, Arlo, Domino's Pizza, ReCorp, TransUnion, Hyatt, Yelp. There's lots of huge partnerships that this company already has, and they've had those partnerships for decades with many of these. They have long-term, lasting, consistent customer stickiness, and this is a company that with its awesome data analytics and the type of software that it provides to its customers, I likely don't see those revenue streams ending anytime soon. And just like I was saying with their stickiness with their customers, the type of model that this company has, that when they sell products to customers, they integrate with their entire platform. And so if a customer customer ever wants to leave that platform, it is incredibly hard for them to leave. It takes a lot of risk for that business, and it is very costly for them to devolve out of Splunk. It is usually very hard once they integrate with Splunk's platform and their business model. So Splunk is one that's really interesting. Like I said, while it has great revenue growth and a little bit of profitability issues, this company trades at a significant discount of its previous all-time highs at around $225 a share or so, and today it trades at $112. And so when you look at a market that is at all-time highs, it's easy to think that pretty much every stock is trading at a high multiple. But if you really look and you try to scrape down there for deals, you can find opportunities in the stock market where even in an overvalued market, you can find five undervalued growth stocks, which are CHWY right here, trading at $75 a share, Tattooed Chef, currently trading at $22 a share. We also have names like Corsair Gaming, currently trading at $31 a share. And then we also have Spotify. Spotify is currently trading at $236 a share. And then last but not least, we have Splunk, currently trading at $112 a share. But thank you guys for watching all the way to the end. I really appreciate it. Like I said, $30 for getting signed up. So if you want to check out that down below, go ahead and check out that. Thank you guys so much for watching, and I'll catch you guys next time.